Hello everyone, my name is Nigel Ball and I'm Global Head of LBO Finance at SG Corporate and Investment Banking. By way of introduction, I've spent 26 years in the banking industry, of which 19 years have been in leverage finance. In this short presentation, I will specifically address the financing of leverage buyouts, or LBOs for short. Firstly, I will define an LBO and consider the size of the market and its evolution. Then I'll provide a brief explanation of the various parties involved in an LBO deal. And finally, I'll run through an example of a generic LBO to try to demonstrate how the deals are typically structured. So looking at this next slide, let's start by clarifying what we mean by an LBO. Well, we define an LBO as an acquisition of a target company by a new company that's specifically established for this purpose and which is majority owned and controlled by private equity or financial sponsors as they're otherwise known. The LBO is financed with equity from the financial sponsor, but also with a significant amount of debt from banks and debt funds. The quantum of the debt is measured as a multiple of EBITDA. That is earnings before interest, tax, depreciation and amortization. This is known as the leverage ratio. This ratio would typically be set at a level above that seen in normal corporate lending, usually a multiple exceeding 3 times, but as high as 7 times. Most importantly, the debt is non-recourse, by which we mean the lenders only have recourse to the assets and the cash flows of the target company and not to the ultimate private equity shareholders. Turning to this next slide, we look at the market evolution over the last 25 years. And we can see that the private equity industry has grown from a small niche industry into a global powerhouse. This slide shows the value of LBOs globally over the last 10 years. In 2015, the total value was just over $400 billion and accounted for around 12% of global M&A deal volume. However, you can see that the values are still some way short of the levels seen prior to the financial crisis, where the annual volume in 2007 reached almost $700 billion. In the aftermath of the crisis in 2009, the value dropped to a low of $116 billion, only 1/6 of the level of 2007. Moving on to the next slide, now let's summarise all of the various parties involved in an LBO. So let's start with the vendor or the seller. This is a private or listed company selling some or all of its business, normally in a competitive auction process. Next, the private equity fund or financial sponsor is the purchaser, and it raises its funds from lots of institutional investors. Their objective is to sell the business, typically after a 3 to 5 year period, having grown in the meantime the profits in order to achieve an attractive rate of return for their investors. The debt providers, well, these are usually a bank or a group of banks that underwrite the debt component of the consideration, typically 40 to 70% of the purchase price, and then seek to syndicate or to sell down a large part of this exposure to other debt providers in order to spread the risk. The management team of the target company will also invest their own money to receive equity in the business. The share of the equity that they receive often increases if they meet certain financial performance targets. And finally, the advisors and due diligence providers. Firstly, M&A providers are usually appointed by the purchaser and the seller, whilst independent experts are appointed to prepare due diligence reports on financial, market and legal aspects of the target company that enables the private equity fund and the banks to conduct a rigorous analysis. On this next slide, let's spend some time understanding how an LBO transaction works and the typical legal and financing structure that's used. This is easiest to explain using a structure chart. In this example, the target company is purchased by a private equity fund for 500 million euros. The target company has an EBITDA of 55 million, resulting in a purchase price multiple of 9.1 times. A new company, or newco, is then established and is funded with equity from both the private equity firm, in this example in an amount of 14.5 million euros, and from the management team of the target, who invests 0.5 million euros. Most of the equity funding from the private equity firm is not invested as ordinary equity, but in the form of a deeply subordinated shareholder loan of 195 million here, as it's often the most tax-efficient structure to use. The management team may receive around 10% of the equity value if they meet their performance targets, but you can see that they only invest 3.3% of the total equity funding. This is what we refer to as sweet equity. A separate new company, Bidco, is then established, and it's a wholly owned subsidiary of newco. And this is the entity used to purchase the target company. Bidco is then funded with equity and shareholder loans that have been raised at newco, and also with 315 million of debt from banks in order to fund the entire purchase price. This combination of the debt and equity proceeds amounts to 525 million and is actually greater than the 500 million purchase price, as additional funds are needed to pay deal costs and expenses. Where it's legally possible, the debt raised at the Bidco is then pushed down to the target operating subsidiaries, so that these loans are actually closer to the companies that own the assets and generate the cash. This is a preferable situation and structure for the debt lenders. The debt remaining at Bidco would then be serviced through the repayment of intercompany loans or the payment of upstream dividends from the operating companies. An illustration of the various sources and uses of funds is provided on this next slide. You can see that in this example, the total funding sources of 525 million euros are split 40% from equity and shareholder loan and 60% from debt. The total debt of 315 million is 5.7 times the EBITDA generated by the target company, and this is the total leverage ratio. This is then further split between senior secured debt with a leverage multiple of 4.5 times and a smaller amount of subordinated or second lien debt, which adds another 1.2 turns of leverage. On the uses side of the table, you can see that some of the proceeds are used to repay the existing debt in the target company of 100 million, since businesses are typically purchased on a cash-free and debt-free basis. To conclude and to summarise, this presentation serves to illustrate a number of key features inherent in LBOs, namely a high level of leverage that enables the private equity investor to improve their returns by actually reducing the amount of equity finance that's required. These returns are typically measured as internal rates of return or simply as multiples of the original equity investment made. The private equity firms can achieve a higher return by selling for a higher multiple of EBITDA than they paid, or by growing the profits of the target. Management teams, as we've seen, invest their own money and are then incentivized with sweet equity if they hit performance targets. This ensures critically that the interests of both the PE owner and the management team are aligned. The debt quantum provided by banks is predicated on the size and the sustainability of the cash flows in the target company. Consequently, it's considered to be riskier than normal corporate lending and requires a very detailed due diligence and a comprehensive credit analysis, but with higher margins and fees paid to compensate the lenders for this increased risk. This concludes my presentation. Thank you for your attention.